While most investors are terrified of a market crash, the top 1% are secretly hoping for one. Surprising, right? Well, it's because they have a simple formula that turns market-wide panic into a once-in-a-generation chance to build serious wealth. They don't just survive the chaos, they use it to slingshot their financial freedom forward by decades. And over the next few minutes, I'm going to show you exactly what that formula is, step by step. So forget everything you think you know about playing defense. Today we're learning how to play offense when everyone else is running for the door. This is not financial advice. This is for education and entertainment purpose only. So let's get one thing straight. Market crashes are not some rare black swan event. They are a feature of the system, not a bug. Crashes are as natural to the economy as seasons are to the year. Since the 1950 alone, the S&P 500 has weathered 11 bear markets. That's a drop of 20% or more. History shows us time and time again that big booms are followed by big busts. It's a cycle. So the real question isn't if the next crash is coming, but when. And more importantly, are you ready for it? For most people, a major market correction is an absolute catastrophe. It's the moment their 401k gets sliced in half, their retirement dreams go up in smoke, and the years of hard-earned savings get wiped out in a few weeks, or even days. The feeling is pure gut-wrenching panic, but it doesn't have to be that way. The pain most people feel isn't caused by the crash itself, but by how they react to it, and that's the first secret we need to understand. To see how the prepared investor wins, we have to first break down why the unprepared investor loses. It all comes down to a nasty cocktail of human psychology and a total lack of game plan. Think back to the dot-com bubble in 2000. People were literally quitting their job to day trade stocks in companies with no profits, no products, and sometimes no clue. The story everyone told themselves was this time is different. Greed was in the air. When it all burst, the Nasdaq lost nearly 80% of its value. Fortunes, both real and on paper, just vanished. Then we got 2008, the great financial crisis. This time the fear was even bigger. Because it wasn't just about the tech stocks, the entire global financial system felt like it was teetering on the edge. So what did the average investor do? Exactly what their screaming gut instinct told them to. They sold. They logged into their accounts, saw their balance bleeding out, down 30-40% or more, and hit the sell button to stop the pain. They sold right at the bottom, turning temporary paper losses into permanent real-life devastation. This is the classic mistake, and it's driven by a primal fear of loss. Behavioral economics have shown that the pain of losing a dollar feels twice as bad as the pleasure of gaining one. When the market is in a free fall, that emotion completely hijacks the logical part of your brain. The media throws fuel on the fire with terrifying headlines and non-stop markets in turmoil. It creates a panic feedback loop. Fear leads to selling, which drives prices lower, which creates even more fear. The other side of this disaster is the paralysis that comes after. After getting burned by selling at the bottom, many investors just stay on the sidelines, waiting for things to feel safe again. But here's the thing. By the time the headlines turn positive and the economy feels stable, the market has already roared back. The single greatest buying opportunity has already passed them by. They sold low and are now forced to buy high if they ever work up the courage to get back in at all. They get whipsawed, losing on the way down and missing out on the way up. This is the cycle of wealth destruction that traps 99% of people. They are just reacting to the news, not following a plan. But what if you could flip the script entirely? What if you saw the market crash not with fear but with genuine excitement? Well, this is exactly how the world's most successful investors, people like Warren Buffett, see market turmoil. They don't just see a crisis, they see a sale. It's a Black Friday for the world's greatest companies. They operate on a completely different model, the wealth preservation and accumulation model. It's not about just gritting your teeth and surviving the crash, it's about actively using the crash to scoop up high quality assets at prices you might never see again in your lifetime. This isn't some complex high frequency trading algorithm, it's a formula built on two simple pillars. Understanding the key signals that the market is getting overheated and unstable, and also having a simple rule-based system that takes emotions out of the driver's seat and tells you exactly what to do before, during, and after a crash. Mastering this is what separates the people whose retirement are destroyed by a crash from those whose retirement are made by one. So let's break down the formula, starting with those warning signs. Smart investors are students of history. They know that while every crash feels unique, the conditions that cause them are often eerily similar. They watch for a handful of key alarms that tell them that the party might be getting a little too wild and it's time to prepare. This is the oldest signal in the book. It's when stock prices get completely unhinged from what the companies are actually worth. A key metric to watch is the Shiller Cap-E ratio, which compares stock prices to their average earnings over the last 10 years, when it's at historical high levels like in the late 2021 or again in 2025. It suggests that stocks are expensive and the risk of a fall is higher. This number is usually paired with a mood of pure euphoria when your Uber driver starts giving you hot stock tips and the news is full of stories about 20-year-old crypto millionaires. It's a huge sign that greed has replaced fear. That's when Warren Buffett's famous advice kicks in. Be fearful when others are greedy. Be greedy when others are fearful. Always pay attention to the Fed. Market downturns are often kicked off by rising interest rates. When the economy runs hot, the Federal Reserve raises rates to cool things down. This makes it more expensive for companies to borrow money, which can squeeze profits and stock prices. But one of the most reliable recession predictors is something called an inverted yield curve. It sounds complicated, but it's not. It's simple. It's simply when the interest rate on a short-term government bond pays more than a long-term bond. This is the bond market screaming that it sees economic trouble on the horizon, and it has come before nearly every US recession for the past 50 years. When the good times are rolling, people and companies tend to borrow more and more money. That's called leverage. It uses returns on the way up, but it pours gasoline on the fire on the way down. You can look for signs of stress in the credit market. For instance, a spike in buy now, pay later services, or the return of risky types of mortgages can signal that lending standards are slipping and debt is getting out of control. When the economy eventually slows, all that debt has become a massive anchor that can pull the whole system down. Spotting these signs doesn't mean you sell everything and run for the hills. Trying to time the market perfectly is a fool's game. Instead, seeing these alarms means it's time to double check your game plan. Make sure your defenses are solid and get your shopping list ready. It means the season is changing and an opportunity is on the way. And knowing the signs is only half the battle. Now for the most important part, the action plan. This is the step-by-step playbook that lets you systematically turn chaos into opportunity. So before the storm hits you, build your fortress. The foundation of that fortress is true diversification. I don't mean owning 20 different tech stocks, that's just concentrating your risk. Real diversification means spreading your investments across different non-correlated assets. Think of it like a sports team. You don't want a team of 11 star quarterbacks, you need defenders and a goalie too. In your portfolio, stocks are your strikers. There for growth, but you also need things like bonds, which often hold steady or even go up when the stock falls. You might also include alternatives like real estate or gold, which can be a safe harbor in a financial storm. But the most critical part of your fortress is cash. The wealthy don't see cash as a dead asset earning zero, they see it as dry powder. It is your single most powerful tool in a market crash. Having a nice chunk of cash does two vital things. First, it's a safety net so you're never forced to sell your stocks at rock bottom prices to cover an emergency. Second, it's your ammunition. It gives you the firepower to go on offense and buy those incredible assets when they go on sale. In a crash, cash isn't trash, it's an option on the future. Your portfolio's number one enemy is you, or more specifically, your emotional panicked brain. The secrets to winning that battle is to make your investing decisions automatic. The best tool for this is a dollar cost averaging. It just means you invest a fixed amount of money on a regular schedule, say $500 on the first of every month, no matter what the market is doing. When the market is high, your $500 buys fewer shares, but when the market crashes and prices are low, that same $500 buys way more shares. You automatically become a buyer when things are on sale. This simple automated system ensures you're buying low without ever thinking about it. If you have a 401k, you're already doing this. The key is to never ever stop, especially during a downturn. While everyone else is freaking out, your system is calmly building wealth for you at a bargain price. And if you're already starting to feel more prepared and seeing the next crash as an opportunity instead of just a crisis, do me a quick favor and hit that like button. It really helps the channel and lets me get this message out to help and protect more investors like you. It's a small click that makes a huge difference. Thank you. With your fortress built and your automatic investing in place, it's time for the fun part, going shopping. Warren Buffett famously said that the time to get greedy is when others are fearful. A market crash is that idea in action. It's when a fantastic world-class companies get unfairly punished, letting you buy them at a massive discount. The trick is to prepare your shopping list before the sale starts. During calm times, you should be researching a list of 10 to 15 anti-fragile companies you'd absolutely love to own if the price were 30 to 50% cheaper. These are businesses with rock-solid finances, loyal customers, and a powerful competitive advantage or a moat, and a track record of navigating tough times. Think of companies whose stuff people still need even in a recession. When the crash happens and one of those companies on your list falls into your target buy zone, you don't second guess it. You take some of that dry powder cash from step 1 and you start buying. You probably won't catch the exact bottom, and that's not the goal. Instead, you can do a staged buying. Deploy a third of your cash now, another third if it drops another 15%, and the final third if it falls even more. This is how you systematically take advantage of other people's panic. This entire formula is worthless without the final step, mastering your own mind. All the plans in the world don't mean a thing if you let fear grab that steering wheel at the worst possible moment. First, you have to starve the fear. When a crash is in a full swing, turn off the 24/7 financial news. It's engineered to make you panic. Limit checking your portfolio to once a week or even once a month. Trust the system you built. Second, look at the future. Instead of obsessing over the red on your screen today, imagine yourself 5 or 10 years from now. Picture the market at a new all-time high and think about how grateful your future self will be that you had the guts to stay invested and buy more during the great crash of 2020X, whatever. While history is no guarantee, it's worth remembering that every major crash in the US history has been followed by a recovery, a new all-time high. It's a long-term game. Don't get shaken out by a short-term noise. Finally, surround yourself with the right inputs. Read books on long-term investing. Listen to voices that reinforce a disciplined mindset. Your mind is a muscle. The more you train it, the stronger it will be when you need it most. So what's the real secret to outsmarting market crashes? Well, it's realizing that a crash isn't just an event to be feared, but a process you can understand and use to your advantage. It's seeing the warning signs of bubbles and hype, not as a reason to panic, but as a signal to get ready. And to make sure you're always ready for whatever the market throws at you, hit that subscribe button and ring the notification bell. It's your first step to staying disciplined and informed. Stay safe and invest smart.